Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hope everybody had a very beautiful day. And in today's markets, guys, well, the consolidation to the downside simply continues right now off of the back of a heck of a rally in interest rates. Take a look at the interest rates here today, guys. 20-year yield putting in another 1.37% day to the upside. Very high momentum to the upside in yields over the past 2 days. And even the 10-year as well, right? 1.36% to the upside, really magnifying those gains that we've had over the last couple of days in yields. But why is that the case? Has anything changed? Well, to be honest with you guys, not really. We haven't had much in the terms of macroeconomic data. That is coming tomorrow. Tomorrow we have GDP numbers early on in the morning. And then Friday we have an inflation report coming in terms of the PCE data report. So what exactly happened yesterday and today? Well, we only had a bunch of Fed speakers over the last 2 days, and they were kind of reiterating the same thing that they've been saying now, guys, for the past 5-6 months. Interest rates will be maintained higher for longer until they are sufficiently done or sufficiently happy with the progress on inflation. So really nothing new, but in the process, the speculation on yields has had a heck of a bid to the upside. And you guys know when yields move quickly to the upside, at least, well, your markets tend to have a little bit of a downturn. And today was definitely magnified to the downside. SPY and QQQ both to the red, but the red did not end there, guys. Every single thing in the market, almost every single thing, was down today with a few little exceptions. NVIDIA and Netflix were two of the ones that were carrying the market on their backs today. Apple with a little bit of a flat day as well. But for the most part, guys, really big sell-off day in the markets. Even though it didn't feel like that, there is just no market breadth, right? And that's what we've been saying ever since the start of this week yesterday. There's just no broad market bulls in sight. They are bidding up a few tech stocks here and there, but for the most part, guys, really pulling back on the market bullishness right now. Healthcare down, financials down, the bottom half of the market not cooperating as well, which leaves us with a one-day relative performance, guys, of every single sector in the S&P 500 coming down in the red. A few very, very red, 1.5 percentage points, which leaves us on a 1 week relative, guys. Really only technology continues to shine, and it's really not all the names in technology. Take a look at your 1 week, really only semiconductors and Meta. That's pretty much it. The rest of the market, this is the 1 week chart, everything in the red. So a little bit of a consolidation. And we were really talking about this, guys, leading into the all-time highs, how we've had nice 4 or 5 weeks of rally in a row, and we could potentially be due for a little bit of a weekly pullback. And I really do believe that this is the start of that potential weekly pullback. It would be a great opportunity for it nonetheless. We really got to keep our eyes peeled on what data we get tomorrow on GDP. If GDP comes in lighter than expected, expect the markets to continue their downturn. And then on Friday, if we get a less nice than expected inflation report, well, then that too will contribute to bringing markets down. Has anything fundamentally changed in the markets in the last few days? No, just technical price action still remains healthy in my opinion, guys. The pullbacks in this market right now are still dip buying opportunities for the most part. The earnings cycle, although we've had a few slips up here and there, has been a fairly bullish earnings cycle so far. Inflation is still trending towards the downside. The economy is still very resilient and the jobs market is still very strong. So nothing really has changed fundamentally in these markets. So what we're going to do in today's video, guys, sorry for the long introduction, but it had to be said on such a red day like today, right? So what we're going to do in today's video, we're going to obviously look at one company earnings that really pooped the bed here today, guys, and that is going to be taking a look at our Salesforce earnings. So Salesforce came out after the close and had their worst day. If they open tomorrow to the degree that they're red in the after hours right now, about down 16-17%, if they do open like that tomorrow, it would be the single worst day in the company's performance since the Great Recession in 2008. Let that sink in for a little bit, right? They have just round tripped all of the gains for the entire year, coming back all the way down to price levels now from back in December. Now, on tomorrow's plate, we're going to be covering Costco. So hopefully Costco will shed some light into consumer spending habits. And tomorrow we also have a few more interesting companies we could take a look at. Zscaler is going to be one of them. And then we also have Marvell, right? So a few big companies are reporting tomorrow. So we'll do our best to cover those on the channel on the Thursday close. And then maybe a few of them we will put into the Friday market video close. So that being said, guys, after we take a look at CRM earnings, we're going to take a look at our major technical analysis rundown on our major indexes, then dive into our tech names. No portfolio update for today. I'll most likely do that tomorrow or on Friday. So let's jump right into today's video, guys, right? So let's do CRM earnings to start it off with here. And you can see that unfortunately the stock is down tremendously in the after hours right now, right? 17% plunge in the after hours. We'll see how it opens up tomorrow. But this was just another case, guys, of less than perfect guidance. So the company's quarter actually came in quite standard. However, they did miss on revenue. This is the first miss on revenue for the company in years at this point, guys. Dare I say, I think it's been about 5-6 years since CRM has missed on revenue. Now, the miss on revenue is very, very small and was counterbalanced with a nice little beat on EPS. EPS, arguably a more important metric, but Wall Street just did not care. Why? Once again, guys, bad guidance. And bad guidance has absolutely crushed stocks this most recent quarter, as we've seen with Meta, as we've seen with Netflix after their earnings, and the list can really go on. We've seen this time and time again this quarter where companies can have a great quarter, but if their guidance is less than perfect, we've seen 10, 15, 20% sell-offs on very, very big names. And that seems to be continuing with CRM's performance today. So why were the numbers so bad? Let's take a look at it here, guys. Salesforce shares plunged 16% on the first revenue miss since 2006. So I'm mistaken. It's actually a lot longer than that, guys. Almost, right? Not quite. Almost 20 years that they have not missed on revenue. So this is definitely a big one. Now let's take a deeper dive into the earnings right now. Salesforce saw budget scrutiny and longer deal cycles than usual during the quarter. President and Operating Chief Brian Milham told analysts on a conference call. Essentially what this means, guys, is as we've seen in software companies so far this year, the billings are just not there, not what they were last year at least. Even large companies are feeling the pressure of higher interest rates and higher pricing and are cutting back on spending on software. Or if they're cutting back, guys, it's not to say that they're not going to purchase it at all, but maybe they're waiting for the next year when interest rates are a bit lower and when companies have a bit more free cash flow to allocate to softwares as a service, right? So that is what they're saying right there in terms of the lightness and in terms of the budget scrutiny and longer deal cycles, right? Companies really pushing those deals back into the future. Now, Salesforce lifted its earnings forecast for the 2025 fiscal year. So although their guidance for the next quarter was a little bit lackluster, they maintained their guidance for the rest of the year. The company now expects adjusted earnings of $9.86 to $9.94 a share compared to $9.68 to $9.76 3 months ago. So they raised their forecast on EPS. Its revenue guidance remains at $37.7 billion to $38 billion, which is what they had last quarter. Analysts were expecting slightly above that at 38.08. So we can see, although the guidance is falling only about 1% short of estimates here on revenue, and they actually come in better than expected on EPS, just was not good enough for Wall Street. Wall Street really having a little bit of a temper tantrum, guys, whenever the guidance is not absolutely perfect this quarter. Now, Amy Weaver, Salesforce finance chief, said she expects deal compression and slowing projects in the professional services business through the current fiscal year. Just goes to say what we were saying earlier, guys, companies are cutting back on software as a service firms, right? And you can include all of your cybersecurity plays into that niche as well, because they too have been affected by this now for the past 6 months. Now, a drop of this magnitude on Thursday would mark Salesforce's worst day on the market since the 2008 financial crisis. So not that good, guys. The gist of things, well, unfortunately, businesses are spending less on software, and that has hindered CRM's ability to raise its revenue guidance throughout the remainder of the year. However, the numbers are not that bad here, guys. Here is something that we pulled up from a Twitter account that I follow called the Stock Market Nerd. Thank you very much for the chart. So take a look at these earnings, guys. They're really not that bad, right? Barely missed revenue estimate by 0.1%, and they barely missed the guidance by 0.2%. So tiny. The sell-off on CRM right now, in my opinion, very much overdone. Now, they also missed a tiny little bit on the RPOs. RPOs are remaining performance obligations. How much money does the company have in the pipeline for future deals? Now, the expectation was for 11% year-over-year growth, and they came in with 10. Only a 1% miss, guys. Not the big of a deal, right? Now, they did beat on EPS on GAAP, and they also beat on EPS on non-GAAP. In terms of the annual guidance, as we saw before, they reiterated the annual revenue. This is true, and which is slightly lower than consensus by not even 1%, guys. They also slightly lowered the annual revenue subscription revenue guide. They lowered the annual GAAP EBITDA margin guide from 20.4 to 19.9. So a little bit of a hit in the margins, but you would not expect the company to go down 17% with such tiny misses, right? Very, very, very timid market and very, very overreaction in selling from the algorithms, in my opinion. Now, take a look here, guys. They also raised the EPS. This is true, but look at their numbers. Their numbers are fine, right? Take a look. Here's Q1 2022 all the way through Q1 2025. They run one tax year ahead. That's why it says 2025 right here. Look at the revenue expansion, guys. Revenue has been steadily climbing. Now, slightly coming down off of the highs of last Q4, but that's normal for a lot of companies, guys. Q4 is usually their best quarter, and Q1 is usually their worst quarter for a lot of companies. So to see them drop not that much is not that bad of a red flag, in my opinion. Still up decently in terms of year-over-year growth. Now, in terms of the remaining performance obligations, you can see a little bit of a drop here since Q4 into Q1, but still very healthy, a lot better than it was back in Q1 of 2024. Now, let's take a look at their margins. Margins, guys, expanding. Earnings before interest and taxes, 32.1%, better than all quarters prior. So very, very good for them as well. Now, their net income, how much money they bring into the bottom line, 26.4%, much better than last quarter and tremendously better from the same quarter in the period of last year. And now here's the kicker. Free cash flow, guys. They brought in over $6 billion in free cash flow, which is one of the record quarters for the company. Free cash flow was up 66.6% on a year-over-year basis. Far better than any improvements that we've seen in the last few years, at least. Their balance sheet is also very, very healthy. $17.7 billion in cash and cash equivalents, $5 billion in investments, and only $9.5 billion in debt. So it's not a balance sheet problem either. And it also trades relatively cheap, guys. When we bring up the valuations for CRM right now at the 230 mark, they're trading for about a 23.5, which is very light in terms of the company's history. Their PEG ratio at 230, considering 16% EPS growth, is only a 1.46, which is really not that bad compared to other big tech stocks, or especially other software as a service companies, right? And CRM is known to be one of the leaders in that field. I mean, they are in the Dow Jones, guys. This is one of the largest companies in the world that sells software, right? They do have a market cap right now of about $250 billion. So it's to say something when such a large company has such a big tumble off of such a slight miss, right? The company is doing very, very good things, still expanding in every case that they should be, right? Still expanding EPS very nicely, and still expanding revenue very nicely as well. But it just goes to show the timidness of the market right now. Now, my personal thoughts on this, guys, is most of the money that's being deployed in AI right now has to do with infrastructure. All the money is going into the infrastructure companies, the companies that are building the necessary tools for AI or enabling the AI tools. Any company such as a software company, which is trying to benefit from the AI rally, just really has not benefited much so far. We've seen that time and time again, guys, with software companies this most recent quarter. We saw it with Intuit just last week, one of the most solid companies in the entire game right now, having one of their steepest one-day declines in years. That was Intuit. We also saw it with a few other stocks. We saw it with Workday last week. Workday, otherwise known as a very nice performer over time, right? Even they were down tremendously after their earnings, now down about 20% from there. And pretty much the list goes on. You could take a look at any cybersecurity company. They too have fallen. So very, very unfortunate for a lot of software as a service companies. They are kind of getting encompassed into the AI trade, but they're not benefiting from the same gains that you've been seeing in all of the infrastructure plays. So it's just not ready yet, guys. The amount of money that's being plowed into infrastructure right now, there is a lag, right? There's a lag effect between the winners of the current cycle right now and your potential future winners down the line, which will stand to benefit from augmented AI productivity, such as Salesforce, right? They will probably only stand to benefit from increases in productivity in a few years. So the hot trade now for AI is in the infrastructure, the guys that are building out all the AI services for everybody with hardware, right? In terms of your software plays, I do think that AI will lead to increases in productivity for them, but it's going to take some time, guys. Those productivity increases and getting your employees to all be able to use these tools, that really takes some time to do. So unfortunately, Salesforce just really bearing the brunt of market timidness right now in terms of software as a service. Even another company, guys, another software as a service company that's been down tremendously this year is Adobe. Even Adobe is down, over 20% year to date so far because of the same struggles that they've been having. They just cannot convert this AI narrative into pure profits as much as your semiconductors have been able to do, right? Because they just have not seen those increases in productivity, aka increases in EPS and increases in net margins. So that's the one thing that's hurting CRM right now. Obviously, you guys know that I came into these earnings with a fairly large position in CRM. I had one put contract open at the 250 strike. That is now heavily underwater, guys. We'll probably be down at tomorrow's open, probably around $2,000 on those. And it just goes on too. I had a few call options. One for this earnings cycle, which was due in about 1 month time. I had the 295 calls. Those are probably going to be darn near worthless tomorrow. And I also had some leap calls on CRM too. Those will also probably be down, guys. Probably my single worst day of performance all year so far, just because I kind of went a little bit heavy on this trade. I was sure that CRM, being one of the industry leaders, I was sure that at worst, they may only drop 4 to 5% and maybe bring us down to the 260, 250 range. As the headline said, guys, we had not had a down day on CRM like this since 2006. 16% is almost 2.5 times the expected move. So suffice it to say, nobody expected this one, right? I still do have very long-term conviction in the company, and I still do believe it is trading at an attractive price right now. But as I said, in order for that AI productivity to translate into bottom line numbers, it may take a little bit of time. So unfortunately, a lot of software companies right now are just being left behind in the dust. So I will probably just maintain this position and try my best to farm some premium and get back to that break even. But I would be lying if I told you guys that the recovery is going to be immediate. It may really take some time. It is still, it is still a sector that tends to benefit from any increases in the overall technology sector, right? So if QQQ goes up, at least it will drag these companies to the upside, but their performance will be heavily monitored by Wall Street over the next 6 to 12 months. So that's pretty much everything we had here on CRM, guys, right? The 220 level where it's currently at, I mean, this is big support right now, guys. We're trading at about 230 in the after hours, right? So that's this whole lower range right here. Big range of prior resistance, current support. As a matter of fact, let me draw a box on it so you can see how far this range of support actually goes. It's actually a fairly wide range, 230 all the way down to roughly 205. And I don't believe the bears are really going to be able to get through this area. If anything, this is probably going to be the location where the bottoming out of the stock happens. So if you're a fan of CRM, if you like what they do and you have a long-term vision for the company, I really don't see any short-term red flags. But if you're expecting to make a little bit of a swing trade for an expeditious recovery, or expeditious recovery rather, a quick recovery, right? I don't believe that is going to be the case, unfortunately, for us. So that's pretty much everything we had on CRM here. Still one of the industry leaders, nothing wrong with the company. But as I said, guys, bad guidance and these market conditions of timidness, quite frankly, by Wall Street is just not going to get it done. And we've seen that time and time again throughout the quarter. So that's pretty much everything we had for CRM. Hope you guys appreciated that analysis. And I really do apologize if anybody is down red in the mud pretty much after this one. I am as well, probably my worst day of trading this year. We will make it back, guys, right? We will recover from the losses. I try to be as transparent as possible with you guys. I show you guys the big wins, and I also show you guys the big losses. It's just the part of being a trader, right? At least we came in to this earnings play with a decent amount of cushion already on the year. So we're still positive on the year. It's just unfortunate that now we've pretty much given up our lead against the S&P and the QQQs. We're probably going to be right in line with them right now, about 10-11% year-to-date gains. So moving into the SPY right now, SPY looking pretty decent, although we have had a 0.7% drop. The reason I say pretty decent, guys, is because we really haven't lost many levels today. So we'll see tomorrow with that GDP report and then the PCE report on Friday. We'll see if we lose, guys, 525 to the downside. It will be daily downtrend started on the SPY, and then we will look to probably set some weekly consolidation underway. I've given my targets for the last week and a half at this point, guys. I truly do believe that when we do this weekly consolidation, if it ever happens, at these current levels, probably going to come down into the 516 level and maybe tag this 12 EMA right here. Still a lot of space between us and the lows. However, anything above 494.50, just looking for that weekly higher low for the further trend continuation. And the month of May ends in literally 2 trading days. So we will see how the monthly candle closes. As of now, still looking quite bullish. So we'll see, can the bulls really save this? To save this, obviously, guys, we have to make our way back up in these highs and really start recapturing the essence of this daily uptrend. So far, the bears do look like they're in short-term control. Now, moving into QQQ down as well, 0.7% on the day. So QQQ, as opposed to SPY, still not really in jeopardy of losing this daily uptrend. That would be a loss of last Thursday's low, 452. If we were to lose 452, it would be daily downtrend started, and then we'd be looking for further weekly consolidation. Good thing, however, we are well above our area of all-time high consolidation. So if ever we do pull back here, guys, top end of this range down about the 12 EMA is going to be the target for the pullback. 447 down to about 442. This little pocket right here is where I do believe the bulls find some larger form support before potentially making that next leg of rally higher. So not looking too bad on the QQQs, holding up better than the rest of the market. Now moving into financials. Financials really taking a bath here today, guys. And that once again is as a byproduct of your heightened yields. Financials really get hit the hardest whenever you have a quick increase in yields. So at this point, guys, the daily downtrend simply continues. As soon as we get a bounce, we're going to be looking for the size of the bounce because eventually we do need to reverse this into a daily uptrend. Still no sign of a decent daily bounce in sight. So what we need to see is a reversal of this hourly time frame into an hourly uptrend, and then we will measure the size of the bounce in relation to 4162. If we can get as high as possible, if we can get as high as possible, it'll give us the best chances of reversing this into a daily uptrend. I would like to see the bulls get at least about back above this area of resistance, which was previous support, and get above these moving averages. If we can muster a nice little rally up into the 41.55, well, then we can create enough space to eventually reverse this into a daily uptrend. For now, though, your bears are in full control and we're quickly approaching our higher lows, guys. 40.2. The red flags are starting to mount on financials. The bears have now taken back, almost 80% of the move. So the best chance that the bulls have is potentially setting up for a little bit of a tightening range at the top here, because when we pull back so much, it's very hard for them to just V-shape this, right? So either one of two things is going to be the likely scenario. Tightening range, the best case scenario. The worst case scenario will be lower high into lower low, weekly downtrend, and into further monthly consolidation on financials. So we'll take this one day at a time here, guys. I don't believe that this spike in yields is going to be a permanent thing. I do believe we are still peaking. I would be very surprised if we mount above the highs that we had in April, because we have a lot less market uncertainty than we did back here. Now, moving on to XLV Healthcare. XLV Healthcare also taking a heck of a bath in the past 4 days of trading. Seems as though they can't catch a break, and we're not even daily oversold yet. Yes, the lower time frames are oversold, 4 hour and 1 hour, so we could be looking for a little bit of a relief bounce at this point. But as soon as we do get the relief bounce, guys, since we have now lost the daily uptrend in a clear fashion, right? Clear break of the daily downtrend, just going to be looking for a lower high, and then it's up to the bulls to see if we can get enough of a bounce going. Can we reset this into a daily uptrend? Same logic as back here, right? You need to see a heck of a bounce, and then it takes some time to get that daily uptrend back. So coming into an area of support right now, 141 all the way down to about 137 should be the area where the bulls put a stop to the bleeding right now. But as we saw on financials, guys, at this point, the bears have taken back a lot of this move, 61.8% of the move. So any further, and it really sets up these healthcare markets for a consolidation range at best, and at worst, guys, may end up seeing the weekly downtrend. Would not like to see that happen, because that would just translate into more monthly consolidation for your healthcare sectors. So really, the moral of the story right now, XLF, XLV, truly bleeding. The only reason the SPY is holding up fairly decently is your QQQs. But if QQQs join Team Bear, guys, well, then your sell-off on the SPY will get accelerated. Now, moving on to SMH. pulling back a little bit, 1.67%, but even a 1.67%, guys, doesn't really look like too much in the grand scheme of things, right? So still very, very healthy, still looking for a daily higher low, anything above 228, just gonna be looking for that higher low for further trend continuation. Now we are coming back into a juicy area, previous all-time high resistance, 238.60, and the confluence of your 12 EMA. So it could be a case in point for the bulls to mount a little bit of defense over here and try and mount above and continue this daily uptrend. If for whatever reason we fail and set up for the daily downtrend and join Team Bear, same thing as the rest of your indexes, guys, just gonna be looking for the weekly higher low for the eventual further weekly trend continuation. So this could just be a case in point where the last week of May and the early weeks of June could be a little bit of pullback for these markets before we continue moving higher, in my opinion. Moving on to IWM Russell right now, really not having a good day at all, 1.5% to the downside. Daily downtrend right now, clear as day. Coming into a big location of support. We have now challenged this area so many times over the last 2 years, guys. Support back here, resistance, 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 and a whole lot of congestion over here. So once again, pulling into this area, coming in hot though, going to be looking for the weekly higher low similar to the rest of your markets as long as this daily downtrend continues, guys. Still hunting for those weekly higher lows. Anything above 191.34, looking for that weekly higher low for the potential trend continuation. But as I've been saying continuously as well, guys, this chart, the Russell, will not rally at all as long as yields cannot set a consistent weekly downtrend and we really start getting rid of these inflation concerns, and also we start getting a more defined timeline on that first rate cut. So unfortunate for them, still on a watch, guys, for a little bit of a swing trade if we re-dip into these lower locations right here. And now lastly, our Dow Jones really not having a good day today, and they probably will not have a very good day tomorrow, especially with CRM down 17%. The Dow Jones at that point could tumble all the way down here, and they need to hold these levels here, guys, right? We're coming in hot right now. Not even oversold conditions on the daily, although we do have slightly oversold conditions on the 4-hour and even on the 1-hour too. Tomorrow it's probably going to be oversold crush zone conditions for your lower time frames on the Dow Jones, and that could translate into a little bit of a bounce effect. But similar to what we were watching back here, right? Need to watch out for the size of the bounce. So when the bounce does materialize, guys, if we just blast through this area of support that we were looking for right back here, looking for it to hold, tomorrow we're probably going to get a gap right through that just because of CRM earnings alone. So as soon as we bottom out, how do we know we're bottomed out here, guys? Need to see that hourly trend change. When you get that, need to measure the size of the daily bounce. As of now, the bears have put in a heck of a move off the highs right now. I would not be surprised if the end result is lower high, and then we will see how high is the lower high. If it's only all the way up here and we use this area as a bit of resistance, then the retest of the lows are very likely. However, if the bulls can muster a heck of a bounce and get back up to the 39s, they have a very much better chance here, guys, at resetting this into a daily uptrend. So not looking too good on the Dow Jones. On the weekly, still a decent move higher, still working with a little bit of wiggle room right now, anything above 37,631, looking for the weekly higher low for the potential trend continuation. But with the bears pulling back so much of this move, guys, the best the bulls can probably get is maybe a bit of sideways consolidation at the top, and still looking for that monthly consolidation too, right? So all of this movement, guys, is very healthy. It's been extremely volatile here over the past 2, 3, 4 weeks of trading. And I do expect that to continue potentially into the month of June, guys. The key factors we need to look out for, guys, GDP numbers and your inflation numbers, right? We need to start seeing, inflation continuing its downtrend. Just remember the first 5 months, or arguably first 4 months of this year, inflation reads have come in hotter than expected. So we need to start lining up 2-3 good inflation reports in a row, really cool everybody's emotions in the market right now, because as you've seen, guys, Wall Street is just they're flooring companies that are doing otherwise very good. They're just flooring them if the expectations aren't to par or aren't beating expectations on guidance, right? And the reason for that is just we still have a little bit of climate of uncertainty right now. Is there going to be a recession? Is there not going to be a recession? Yield curve inversion, interest rates super high, inflation, GDP concerns. Is the job market still safe? all of these things, even though they are a lot better than they were at this same period last year, we still have a certain degree of uncertainty in the markets right now, which is really preventing us guys from really casually trending, right? So going to be still a very, very volatile time in the markets, but could still be a very juicy opportunity, guys, to continuously shop for your favorite companies, because not everything is up this year, guys, right? Still a lot of companies year to date that are underperforming the SPY. A lot of beautiful companies, you know, when we pull up this chart, it looks like big tech is doing a lot of the work, and they are doing a lot of the work. You have had some other outperformers, right? Walmart, Costco, Eli Lilly are up substantially more than the S&P. Financials, a couple of them are up substantially more than the S&P, but there are a lot of deals to be had in here, guys, that are underperforming the markets year to date. So now let's move on to our big tech names, shall we? So moving into Apple right now. Apple only up about 0.16%, but it's a good thing here, guys, because they were one of your only names in the entire market today that were somewhat green, right? So fairly decent day on Apple. However, we will be looking to last Thursday's lows, 186.88. If the markets continue to consolidate on a weekly basis here, guys, I do believe Apple will set the daily downtrend, which will send even Apple into weekly consolidation after this big weekly move, right? Big weekly downtrend right here, nice engulfing move. We still need to set up for the weekly higher low for that eventual weekly trend continuation. And this could be a very juicy pattern here, guys. Don't forget, Apple has their investor and product presentation day. I believe it's June 14th or June 16th. So if we do pull back in the markets for the next 2 weeks, could be a nice trade location here. Pull back for an entry on Apple, 180 to 178, huge area of support. If we pull back in here over the next 2 weeks, and then they have their conference here in the second week of June, could be a nice swing trade opportunity on Apple. So that is the type of trade that I am looking out for myself specifically. And obviously, if Apple just bucks the trend and continues north, well, just keep in mind, guys, big overhead resistance at your all-time highs, 194 to about 198. Now moving on to AMD. AMD not really benefiting from that rise in semiconductors today. As a matter of fact, only NVIDIA to the green. So AMD pulling back after nice gains of yesterday. AMD still trapped in this sideways price action, right? No clear trend direction currently. Trapped in a range, guys, right? Trapped between the 172 and pretty much the 158. Fairly wide range. So this is really just coiling up, and eventually we will get that spike in volatility, which will push this market one of two ways. If we break Thursday's low, 158.06, daily downtrend is resumed. At that point, guys, we'll be looking, can the bull set up for the higher low into the weekly trend change? For the higher low, keep an eye on these levels right here, guys. 148, 150. I do believe that that's a huge support zone for AMD. And obviously, if we get the break to the upside and just resume this daily uptrend, well, your next area of resistance is about the 183. Personally, I will be quite patient on AMD in light of our current overall market performance, right? Just considering that the SPY and QQQ could potentially have a weekly pullback, 1 week's, 2 weeks worth of pullback, well, you may be able to find a better deal on AMD if you're patient down below here in the lower 150s. But all in all, stock's doing a good job maintaining the moving averages right now and maintaining this prior range of support, which we are now stuck in right now. So I wouldn't count the bulls out just yet, but if ever overall market performance continues to look like this in the next 2 weeks, AMD most likely will follow the trend, and you may be able to revisit these lower price ranges. Now moving on to Amazon. Amazon also trying its best to stay green for the day, but couldn't quite get the job done. So Amazon currently still in this nasty daily downtrend right now, but we do have a pretty decent bounce with yesterday and today's trade. So we'll see if the bulls can get above 184.66, your downtrend is stopped, and then they will have a chance in resetting this to a daily uptrend and start attacking some of your prior all-time highs. However, if it just continues following the overall market, we could be expecting Amazon to continue the daily downtrend and start revisiting some of the lower areas of support. This is going to be a big one here, guys. 172, 175 range on Amazon. Going to be a very, very highly contested region by the bulls, in my opinion. And the weekly higher low is all the way down here, 166.62. So really no chance of losing that just yet. If anything, we may come down, tap the 175, 172 range, and then probably muster up another rally. And it'll remain to be seen, can we finally fracture this area that the bulls have been stuck, right? We've been stuck trying to break these all-time highs now for the past 3 years at this point. I know not all at the same time, obviously, but just to show you guys how challenging it's been for Amazon to really mount above and close the 190. Moving into Google at this point, give me a quick second. All right, so moving into Google only down about 0.35%. You really wouldn't be able to tell from the chart though, however, right? Red day, but a green candle. So Google holding up better than most, still in a very nice daily uptrend, but we have to be careful here on Google. If we were to lose the 174.81 last Thursday's low, it would be first daily downtrend on Google, the first one pretty much since all the way back here in the month of April. Daily downtrend and loss of the 12 EMA could send us into a little bit of weekly consolidation. Good thing for the bulls though, anything above 165.50, just going to be looking for a weekly higher low for a potential trend resumption in maybe the second half of the month of June. So no real red flags on Google just yet, still holding up better than most. I don't see any red flags, just tough to initiate a position over here. If anything, and we remain patient on Google, guys, and Google continues to drop, I'll probably be making a little bit of a cheeky swing trade play here, guys. If we can revisit close to the 165 level, that's where I may try to pick this stock up. Now moving into Meta. Meta actually down 1.16% on the day, but not too bad, right? Meta still not yet in jeopardy of losing this daily uptrend. That will be a break of the lows right here. 460. Keep a very close watch on your 460 level. If we were to lose this, guys, daily downtrend has commenced, and your weekly consolidation after this nice 4 weeks of earnings rally will also start manifesting too. Now, the bulls have put in a decent bounce in relation to the drop, coming up about 61% of the move, but it doesn't guarantee them the weekly trend change. They have a very good chance, but it doesn't guarantee them. Still, however, I do think there's a great trade opportunity, guys. If we were to revisit the lower 450, 440 levels, could be a great swing trade opportunity to try and pick the weekly higher low. The stops go below here, and you're targeting the all-time highs and beyond as your take profits as a bit of a longer form swing trade, right? So looking fairly good on Meta, still no red flags. The bulls, though, really need to mount and close above this 482, get that daily uptrend in motion, mount above this big prior level of support right here, which is now big resistance, get us above there, tap it, and then run. That would be the breakout retest trade. And this trade also juicy trade opportunity. If it happens, guys, retest trade, the stops go below these lows, and then you're targeting the all-time highs. So risk to reward on both those trade styles, whether you're waiting for the breakout retest or the potential hunting of the weekly higher low right here, both representing some decent trade opportunities and ideas on Meta, in my opinion. Moving on to Microsoft right now, down 0.27%, but you can't really tell. Same concept. Red day, but a green candle. So Microsoft still maintaining a very tight range at the top of the all-time highs, right? Still unable to break this. Now, if we do close below 424.26, which is last Friday's close, the daily downtrend on Microsoft starts. At that point, you have to look to lower areas of support. This top end of the range of consolidation could be a first line of defense for your bulls. That's around 415. And if they do start the daily downtrend, well, Microsoft too will start its weekly consolidation after 5 weeks of nice rally. And look what we have here, guys, on the weekly. Decent little level right here, right? We have confluence of this line, the 415 that I was showing previously, and the 12 EMA, which is about 417, could be a nice little location for the bulls to pull back into, set the higher lows, and then move on to better things throughout the rest of the year. That is the type of swing trade that I may be looking to do myself on Microsoft. So we'll take this one day at a time and see how this one plays out. But as of now, guys, no real red flags on this company. Moving on to Netflix at this point, Netflix really not even caring what the market was doing today, up another 0.87%. Netflix, one of the more solid charts that I've seen here, guys, over the past few weeks, really just not caring what the rest of the market is doing, continuing to plow forward. And that's what we like to see. Daily uptrend is still underway. Any pullback at this point, anything above 631, just going to be looking for that daily higher low for the further trend continuation. And now we have a big area of support below us here, guys. All of this resistance is now support below us. Going to be very tough for the bears to get through this one. So even if we were to lose some of these levels, it's going to be tough for them to get all the way down and close below 606. That's just my opinion. Now, if we do have that daily consolidation with the rest of the market, well, Netflix is going to go for the same thing that we were talking about, Meta, Microsoft, and the rest. Apple, all of them pretty much have the same chart at this point. Google as well, right? So if ever we come down on that daily downtrend, just going to be looking for a weekly higher low for the continuation of this gorgeous weekly uptrend. Your last line of defense right here, I truly do believe, is that 607 down to 600, confluence with your moving average as well. So keep a close eye on that location for Netflix stock. Decent amount of cushion from us from now until then, though, about 7.5%, right? So the markets would really need to slide heavy for Netflix to get all the way down below here. Moving on to NVIDIA now. NVIDIA just not caring about the rest of the market either, right? Glorious daily uptrend right now on NVIDIA, but we are getting slightly overbought. I know that doesn't mean anything for a lot of NVIDIA bulls because we can't stay overbought for a long time, but just something to take note of, right? Even the 4 hour, slightly overbought too. Add your 1 hour, no longer overbought, but now just range-bound consolidation. So if we were to lose this hourly uptrend into tomorrow, that would most likely signal that daily consolidation is underway, and we will monitor for the size of the pullback. Honestly, now, at this point, the bulls have put in so much space, guys, that a retest of the 960 prior all-time highs is quite unlikely, right? That would be a considerable drop of about 16%. Probably not going to be the case and point for NVIDIA to get all the way down there. So what are we looking at then, guys? Well, keep a close eye on our daily 12 EMA. That could be a nice area for the retest. If we start moving down casually into this range, the 12 EMA will catch up and may even match the stock price up in the 1,050, 1,060 range. That's going to be a likely area of support for the bulls. And then we'll see, can they continue the daily uptrend, or will we head into a little bit of daily downtrend consolidation and a little bit of weekly consolidation as well after such a nice 6-7 weeks of rally on the stock? All in all, no red flags for the company as well. We will see how long can they continue to outperform the overall markets. Eventually, guys, NVIDIA will have to have a pullback, and we will be ready. Depending on the size and location of the pullback, I will let you guys know if there's any juicy trade setups. Moving into Tesla right now, Tesla really doing nothing, right? 0.32% to the downside, but it doesn't really matter, guys. Tesla has really just been trapped in this price range for a better part of the last 3 weeks at this point. So the few levels of contention right now, 172.35, that is your immediate support. It's an important level because if we were to lose that, Tesla would lose the daily uptrend and risks going into a daily downtrend. And if that happens, guys, close eye on the lower 160 level. Why is the 160 level so important? Because if we lose this daily uptrend into daily downtrend, it means that also could be setting up into a weekly downtrend. Look at this candle formation. They had the weekly trend change attempt in their hands, but now having set the lower high, if we break these lows right here, 168, new weekly downtrend would confirm if we close a weekly candle below here. That is why this location is so crucial for the bulls to defend. So we'll see, can the bulls get it done? Or will we have another leg of selling and will send us into a furtherance of the weekly downtrend? And then we'll be looking to the 160 level, guys, to really act as that last line of defense. It is also a huge level on the monthly too, right? We can see that right here. Huge monthly support. We got lower than it in the month of April, but so far the bulls seem to want to put a stop there. So we'll see, can Tesla stock hold? I mean, it's not looking the strongest right now, but then again, the bears still do have to get through a few crucial levels. I'm still not trading this one specifically, guys, just because it is such an interest rate sensitive stock, and just because I don't believe that their demand problem for the whole auto industry, not just Tesla, I don't believe that it's a snap of your fingers quick fix. I still believe that there's a long time before their demand regains what it was just to be, or regains the levels at which it was a few years ago. That's why I'm not really feeling the urgency to get into this trade right away, even though it is, objectively speaking, at quite attractive levels. Now moving into Palantir. Palantir also, I mean, not having the worst day, not having the best day either, down about 0.5%. That's not too bad. Still holding these price levels. So if tomorrow, guys, the markets are very red off of the back of CRM earnings and earnings concerns in general, maybe the interest rates continue rising as well. Just, all the reasons that the market will throw at you to give you a few red days. But as we know, guys, based off the SPY and the QQQs, right, we know what we're expecting. We're expecting weekly consolidation, right? So if ever that's the case tomorrow, even for a company like Palantir, guys, well, we need to keep an eye on these lows because they will be crucial. These are your last line of defense lows that we pretty much set in the lows of April. If we were to lose those lows, daily downtrend simply continues on the stock, and unfortunately, weekly downtrend simply continues too. If those two things manifest, well, we'll still just be looking for the ever elusive monthly higher low. In my opinion, we can go maybe as low as 19. That is really the bottom end of your prior range of support, the prior range of resistance too, and your 12 EMA on the monthly is right there as well. Seems to be like a very solid location for the bulls to build a larger basis of support before manifesting that eventual rally later on into the year. When software companies, right, Palantir being a software company, when software companies finally start catching a bid once again. A lot of these companies, guys, are cyclical. Yes, their cycles last for a lot longer than, let's say, consumer discretionary companies, but still a little bit of cyclical nature in these companies. As I've explained early in the video, guys, the biggest winner of the AI cycle, the early AI cycle right now, is in infrastructure. Just think of picks and shovels, the same metaphor that people always give about gold mines, right? Well, when you're looking to open a gold mine, these guys win the best. The picks and shovel companies get the most sales up front, and then it takes a while for you to open the gold mine, finally mine the gold, and finally start being profitable, right? So the money will eventually pour in to software as a service, but it can take some time. For the time being, this is still the hottest area of the trade right now. And who is standing to benefit from this big run in infrastructure in the immediate future? Well, unfortunately, guys, it is your largest players, the massive big tech companies right now, right? So moving on to that, now let's move into, so what we have to do on Palantir, sorry guys, nah, not much analysis. If we continue, 19 still a good support. What the bulls need to do, right, need to break 2207, guys. Only a break of 2207 can get us back into daily trend territory and start attacking the 23 level. Still a lot of work for the bulls to do, so we'll keep a close eye on this one. Moving on to PayPal lastly. PayPal dangerously close, guys, to losing the last area of support. This $61 level is absolutely crucial. If we were to lose this, the next basis of support comes in around $57, $58. Now, it's not only PayPal's fault. A lot of software, a lot of fintech companies have been overall down this week. Square has been down. SoFi has been down as well. Affirm, even though I know Affirm's not profitable, Affirm has even been down significantly. So really nobody getting some love, right? It's not really PayPal's fault as much as it is the whole industry's problem right now, right? So as a whole, daily downtrend simply continues right now. Once again, setting the lower high into lower low continuation. So we will keep a watch, guys, when this move bottoms out. But one thing for sure, if we smash through this level, I do believe, unfortunately, this whole box becomes resistance. That's why it's so important. If we break below, they can use this as resistance and continue this lower low and try and find a lower base of support down here. On the weekly as well, guys, if we close a weekly candle below this green box, it is not going to be looking pretty. And you guys know me, I want to be as bullish as I can on PayPal stock. I do own some shares, not as much as I did have. I did trim a lot back in the prior year and whatnot. However, still, I want to be as bullish as I possibly can on this company, but we just have to see what the technicals are showing us right now. Clear weekly downtrend. If we were to close this down below here, close the weekly candle, continuation into the 57, 58 range is going to be likely. And that is really where I'm going to be looking personally to play this company a bit more aggressively. So very, very unfortunate for PayPal to give up all of these juicy levels that we had earlier on in the year. But unfortunately, guys, that's just the way the cookie crumbles. The market is not being kind to companies that are currently in a turnaround story, right? Think of the turnaround story, guys, right? They're just not being kind to them. PayPal is number one. Disney is another one, right? Had a nice turnaround story, but still any sign of a little bit of weakness, look what happens, right? That's another one. Nike, another turnaround story, absolutely crushed. Starbucks, supposedly a turnaround story, absolutely crushed. Palo Alto Networks, right? Turnaround story, trying to reorganize their product offerings for the entire company. Although they're not crushed, they did get crushed, right? So that is the problem that we're having in the market right now. Wall Street is just not being patient with these turnaround stories. They would rather invest in the safer bets while we still have a certain degree of market uncertainty on the tables right now. Wall Street, unfortunately, guys, they would rather invest in your big tech companies or in the infrastructure play in semiconductors, right? And even solid stocks, defensive stocks, Walmart, Costco, Visa, MasterCard, and stuff like that, right? We still haven't seen the true bull market risk on trade happen yet. I've keeping a close eye on it, guys, and you've seen me. I've started to play a little bit more call options, but I haven't gone full aggressive mode for the portfolio and start implementing more long option bullish strategies. You will see that, guys, but in my opinion, the climate is just not there yet. It's like a fruit, right? It is almost there, but it's not yet ripe for the taking. That's why I'm still being a little bit more risk averse and I'm still selling a lot more options than I am buying options, right? The time will definitely come, but I just don't think it's ready yet. How do we know that time is ready, guys? Well, you guys will know because the recovery story stocks will start doing a lot better despite the fact that their fundamentals won't be improving. Won't be improving. Well, they'll be improving slightly, but you won't see improved fundamentals recover like this, right? It'll take some time, but eventually Wall Street will start rotating into the trades that are not popular right now. These themes, right? Remember these themes, very, very, very crucial for us to remember. So all of the ones that are currently tough to trade, eventually they will be traded by Wall Street. But for that, we need an overall more bullish environment, need to take more uncertainty off the table. Give me 2, 3, 4 bullish inflation reports in a row. Give me Jerome Powell saying, okay, September is most likely going to be our first rate cut. When we start taking all that uncertainty off the table and we get more confirmations that the economy is actually going to do good and probably not going to head into a recession, even though it could be a light one, right? That is when we'll see a more risk-on environment in the markets. So we'll take this one day at a time, as we always do on the channel. I'll keep showing you guys my wins, my losses, and everything in between. So hopefully you guys enjoyed today's video. If you did, consider dropping a like. Would really appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Would love to have you here. We do these videos every Monday to Friday after the close. And as usual, guys, if you have any questions at all, questions, comments, a stock you want me to look at, technical analysis, an options play that you're considering, anything you want, leave it down below in the comments and I'll get back to you within the next 24 hours. So take care, guys. Happy trading. I'll see you tomorrow after the close. Peace.